Welcome to the Deep Dive. Today we're going to cut through all the noise from the S&P Global Q3 2025 earnings call. Our whole mission here is to filter out the jargon and really give you the key strategic and financial takeaways that, drove that huge bullish reaction from the market.
It's a pre-market call, October 30th, and the tone from management was just one of profound confidence right from the start.
You feel it.
Yeah, the results were exceptional, and the message was all about accelerating growth. The market jumped on it. That spike in the share price and the volume tells you everything you need to know.
Okay, so let's unpack that exceptional performance. The headlines were pretty massive. I mean, we saw adjusted earnings per share, EPS, hit $4.73.
A huge beat.
That's a 22% increase year over year. It just blew past the consensus.
And that 473 is impressive, but it's the quality of the beat that really matters. It's defined by the operating leverage. Revenue was strong, sure, at $3.888 billion, up 9%.
Right, slightly ahead expectations.
Exactly. But here's where the power of the business really shines. The adjusted operating margin. It expanded to 52.1%.
52% margin. I mean, for context, what does a 330 basis point expansion like that actually mean for the business?
It's the clearest sign of just incredible internal discipline.
Okay.
When we say 330 basis points, it means they squeezed an extra 3.3 cents of profit out of every single dollar of revenue compared to last year. Expenses only grew 2%.
Only 2%.
Yeah, and that massive gap between revenue growth and expense growth, that's the engine. That's what's driving this whole story.
And that confidence, it's built on that top line growth and expense control. And it just translated directly into their forward outlook and capital allocation. This is where the story gets really interesting.
Well, it's fascinating because of the sheer commitment to returning capital. They'd already returned nearly $1.5 billion to shareholders since the last call. But the real headline was the announcement of an additional $2.5 billion share repurchase plan for the fourth quarter.
Wow, that's a huge number. What does that signal to you when management sees their own stock as the best place for that much cash?
It signals they think it's the single best investment they can make, period. They're projecting this will return about 85% of their 2025 adjusted free cash flow.
So they're funding this with cash from divestitures, but also taking on new debt.
Exactly. And there's this structural tension there. They're taking on about $1 billion in incremental debt to fund an acquisition, but at the same time committing billions to buybacks.
So how do you reconcile that? Maximizing immediate shareholder returns versus funding long-term strategic growth.
It's just pure confidence. They're using debt for acquisitions that immediately deepen their moat, their proprietary data, and then using all the excess cash flow to just aggressively reduce the share count.
And that buyback is accretive, right?
Right. They said it's expected to be slightly accretive to adjusted EPS starting in 2026. So it's an immediate boost.
A nice compounding effect. And speaking of the future, those strong Q3 results led to a meaningfully raised full-year guidance.
Yep, they lifted the whole bar. Full-year revenue growth, that went from a 5 to 7% range up to 7 to 8%.
Okay.
Full-year adjusted EPS was lifted to a range of 1760 to 1785. And critically, the full-year adjusted operating margin, that's now expected to be between 50 and 50.5%.
So the market sees those gains as structural, not just a one-off.
Exactly.
So beyond the financials, the big narrative was really sharpening that strategic edge. It's like a purification of the business. Let's talk about that aggressive push into private markets.
The focus is so clearly on higher growth, higher margin data. The centerpiece is that planned $1.8 billion acquisition of With Intelligence, or WI.
And WI is focused on private markets, right? Private equity, credit, hedge funds.
All of it. It's a classic moat-deepening move. The private market space is just exploding with demand for professional data. This gives them a whole new set of tools.
And they're funding that with the new debt and cash on hand.
Right, which confirms they see this as absolutely essential spending. And you should also mention the completed acquisition of ARC Research, which is all about private wealth data. They're seriously beefing up the private side of their data house.
And while they're buying, they're also doing some, like you said, corporate spring cleaning.
Oh, absolutely. The OCTRA sale closed in early October. Then they announced they're divesting both enterprise data management, EDM, and ThinkFolio.
Good businesses, but maybe not core to the new vision.
Precisely. They don't fit that vision of a high-margin, high-growth information utility.
Plus, the mobility spinoff is still on track.
Still on track. Management was very explicit. They said this multi-year portfolio optimization within market intelligence is now, quote, substantially complete.
So the shuffling is basically over.
The shuffling is over. They're focused.
All right, let's dive into the engine rooms then. What drove the acceleration? Starting with ratings. Revenue was up 12%.
Yeah, and that strength was driven by really robust bond issuance. Market conditions are favorable for refinancing, and they're actually expecting mid to high teens issuance growth in Q4.
So a strong tailwind there.
A very strong tailwind. And RES, their rating evaluation services, had a record quarter. The maturity walls through 2026 look solid, so the core ratings business is resilient.
And indices kept pace, up 11%.
Yep, mostly benefiting from higher assets under management, or AUM, and net inflows. That drove a 14% growth in their asset-linked fees.
But the real standout, the one that I think caught everyone's attention, was market intelligence, MI.
MI was the star of the show. 8% organic constant currency growth. That's their strongest organic growth in 6 quarters. The turnaround in that segment is real, and it's accelerating.
So why the acceleration now? What changed?
Well, management pointed to a few things. Strong execution, a streamlined sales model, and some really critical competitive wins.
Like the big investment bank win.
Exactly. They highlighted a major investment bank adopting Capital IQ Pro as its primary desktop. I mean, that's a massive switching event. It shows their platform, now with Visible Alpha and their new Gene AI tools, is actually winning in the market.
That brings up a huge question about the structural story here. Artificial intelligence. They've poured over $1 billion into AI since they bought Kensho back in 2018. How is that paying off?
Management stressed that this early investment allowed them to innovate, quote, economically, relative to their peers. They weren't scrambling to catch up.
And now we're seeing the products.
Now we're seeing the products. They highlighted Document Intelligence 2.0 in Kappa Q Pro and an AI-powered document search in iLevel, which is their private markets platform.
So the tech is what's driving the competitive wins, which leads directly to the moat, right? The core defensibility of the business.
It is the moat. Management drove this point home. Over 95% of total company revenue is derived from proprietary or heavily curated enhanced data.
Wait, say that again? 95%.
95%. That is the ultimate defensive statistic.
So less than 5% of their revenue is from, easily replicable public information.
That's right. Only about 5% of total revenue, which is about 12% of MI's revenue, comes from stuff like 13F filings that anyone can scrape. Their whole strategy is expanding the proprietary data set and digging deeper into customer workflows.
And they're using new channels, too, like the hyperscalers.
Yeah, partnerships with Microsoft, IBM, Google. They even mentioned that their commodity insights data licensing through Microsoft Copilot is already being monetized as an add-on. It's a very modern way to think about distribution.
So pulling all these threads together, you've got this upbeat tone from management, the hire guide. It all aligned perfectly with the stock's reaction. The story for investors seems pretty clear.
It is. This is a compounding, high-margin information utility that has successfully accelerated its growth and, just completed its strategic purification.
And the next catalyst is that Investor Day on November 13th.
That's the one to watch. They're expected to lay out the multi-year framework for growth and capital returns.
But, okay, before we get too optimistic, let's do a reality check. Were there any friction points at all? Any small headwinds?
There were a couple of small ones, both in the Commodity Insights division. The upstream data portion saw a small 2% decline. That was due to some customer consolidation and lower oil prices. Management expects that to continue.
And sanctions.
And sanctions, yeah. New sanctions were cited as a headwind. About $6 million in 2025 and an anticipated $20 million in 2026. This was the only slight negative in the entire release. It caused them to lower the upper end of the CI guidance range just a little bit.
Got it.
And one final note, which was actually a huge positive sign, they're going to stop reporting on merger revenue synergies.
Why is that a good sign?
Because they hit their target way ahead of schedule. They exited Q3 with a $255 million run rate. By no longer reporting it, they're signaling that the integration is done. The teams are one company now.
Okay, now it's time for the segment we call This Is Not Financial Advice. I'm going to ask you to pitch the outrageous but plausible trade idea based purely on this call and the strategic direction.
Okay. My thesis is basically an activist arbitrage play on what management just accomplished. It is. Long core SPGI stub, Short the mobility spinoff.
All right, walk us through that. Long the core. Why?
The core business ratings, indices, and that newly focused market intelligence is being purified into this high-margin information utility. We're talking 50+% adjusted margins. We saw MI accelerate. We saw rating strength. And we have that massive $2.5 billion buyback hitting in Q4.
So you think the core is undervalued right now because of the complexity of the spin?
I think as that pure play data story crystallizes, the valuation of that core stub the company left after the spinoff is going to soar. You're buying a data-driven, margin-expanding machine.
And the hedge. Why short mobility?
Because mobility, while it's profitable at a 43% margin, is the most cyclically sensitive asset they have left. It faces, and I said this, tariff and regulatory uncertainty. Its margin is way lower than the core's 50% target.
So you hedge against any auto sector downturn.
Exactly. You short the spinoff, you monetize the premium you think the market is going to assign to that purified core asset, and you hedge against any turbulence in the auto sector. It's a pure bet on management strategy.
That's a compelling thesis. It perfectly reflects everything we just analyzed. Okay, that brings us to our final thought for you, the listener. We've covered margins, buybacks, AI. If you had to focus on one single metric that dictates the durability of this company, what is it?
It'd have to be that 95% figure. It just has to be.
The proprietary data.
Yeah. Management's commitment to driving revenue from data you can't get anywhere else, the stuff that's deeply embedded in a customer's workflow. That is the definition of the data moat. In a world where everyone is worried about AI commoditizing data, their focus on differentiation is the single most important structural fact for any long-term investor.
Fantastic. So key takeaways. A massively raised full-year outlook, a huge $2.5 billion buyback plan for Q4, accelerating growth in market intelligence, and a sharp focus on private markets. Keep an eye on that Investor Day. Thank you for joining us for this deep dive.
Thanks for having me.
We'll catch you on the next one.